Hey everyone, welcome to channel's Quick Invest. Today topic is an important one for retailer investor. Back to the year 2020. Remember that feeling? Every Singaporean friend was a stock guru. You bought anything and made 20% profit. But what if I told you that simple gain set most retail investors up for massive failure? Most investors, despite those initial wins, actually lose money over the long run. And it's not because of the market, it's because of their own mind. We're going to break down the 3 fatal mistakes you, the Singapore investor, are making. These are based on psychology, not the market. If you master these 3, you instantly outperform 80% of the retail crowd. Part 1. The Overconfidence Trap. Mistake number 1. The false sense of genius, overconfidence. Your first mistake, the false sense of genius, or overconfidence. The bull run of 2020 made money so easy, it convinced many of us we were brilliant stock pickers. You stopped doing basic fundamental research and forgot the Singapore-centric rule: if a stock's story sounds too simple, it probably is. You became overconfident, stopped managing your risk, and suddenly that 20% gain turned into a 40% paper loss when the market turned, all because you stopped checking the company's balance sheet. Never confuse a rising tide with personal brilliance. Part 2. Chasing hype and herding. Mistake number 2. Following the herd. Fear of missing out, FOMO. The second mistake is one we know well on our little red dot: following the herd. Your friend said Tesla was good, or a WhatsApp group tipped a small cap SG stock. This is pure FOMO. You bought at the peak price, the most expensive, riskiest point, because you were afraid of missing out on the 5-bagger. The classic example in Singapore was the Minibonds saga, where investors were pulled into complex, high-risk structured products based on trust, not understanding. When Lehman Brothers collapsed, many retail investors lost their entire principal. The lesson: if everyone you know is talking about it, you are already too late. You become the liquidity for those who bought early. Part 3. The cost of being too safe. Mistake number 3. The safety trap, opportunity cost. The third mistake is the quiet killer: keeping too much cash. I know, cash feels safe. But in Singapore, with even a moderate inflation rate, holding excessive cash is a guaranteed loss of purchasing power over time. This is the opportunity cost. By constantly waiting for the perfect dip, or trying to time the market, you miss out on the long-term, compounding returns of quality assets. You should only keep 3 to 6 months of living expenses in cash for emergencies. Everything beyond that is capital that is passively shrinking, not growing. How do we fix this? 3 action points to beat the behavioral trap. Number 1. Before investing, write down why you are buying. If your reason is, because it's up, don't buy it. Number 2. Dollar cost average, DCA. Commit to buying a fixed amount every month into a diversified instrument, like a local STI ETF or a global equity fund. This removes emotion and eliminates market timing. Number 3. Diversify. Don't put all your eggs in the grab basket or the latest crypto fad. Use core satellite approach. 80% safe, diversified, 20% for your high-conviction stocks. Be a disciplined investor, not an emotional trader. Did you experience the overconfidence crash of 2022? Let us know your biggest lesson in the comments below. Don't forget to like and subscribe. Disclaimer: information in this video is provided for educational purpose only and should not be considered as financial advice. Always do your due diligence or so speak to licensed financial advisor before making investment decisions.